Thank you, Colleen. 7:49 the time. The U.S. Federal Reserve appears to be on track to cutting interest rates later this year. The Fed signals that it expects to make 3 rate cuts by the end of the year, a move that would be welcomed by Americans struggling with the high cost of borrowing. Financial planner Derrick Williams joins us now to explain what you should be keeping an eye on in this rocky economy. So let's just start with, what did the Fed do at his meeting this month?
So the Fed paused interest rates. So there was no movement. They didn't cut it. They didn't raise it. But the consensus seems to be that beginning potentially as early as end of April, we're going to start to see cuts throughout the year.
Yeah, so what is that looking like in terms of an outlook for the year?
So an outlook for the year is we're going to see slow rate cuts. It won't be like, you're not going to see 5 to 4 really drastically. It'll be a really slow cut. But what that means for the average American is, with these interest rates staying high, borrowing debt or getting loans right now is going to be high. So buying a house is still going to be high. Credit card rates are still going to remain high. But on the flip side, we are still going to see really competitive CD rates and savings rates, where it's going to be really beneficial for the consumer to kind of park money in for potentially a year or longer and get the almost guaranteed rate of 4 to 5%.
What about mortgages overall?
Mortgages still remain high.
Yeah.
They are down from what we saw 8% really high in October, but they have climbed down. Prices have slowly begun to decline, but we're still going to see mortgage rates high throughout the year until Fed kind of starts to bring those down.
Yeah, and also that affects credit card debt too, those interest rates on your credit card bills. Credit card debt is significantly high nationwide.
Yeah, absolutely. And I think that's one of those things that, we're kind of keeping track of, as well as economists, of, credit cards remaining high. So people were thinking, maybe we'll wait until the end of the year and start to refinance, but it's looking like it's going to be better just to begin to pay credit cards and loans down versus waiting for this, maybe cut, pretty quickly.
But it's looking good in terms of savings and CD rates.
Yeah, absolutely. Savings right now, we're looking at, 4 to 5%. So if you have a, place that's only paying you 1%, definitely want to look at, more competitive interest rates, as you see CDs, money markets, and savings accounts paying 4 to 5%.
Say that you don't have those investments and you're looking at this and you're looking at what rates are doing, and you might have some concern. What should you do if you don't have too many ducks in your financial game?
One of the things you should look for is those, high interest rate savings accounts. So you can walk into a, Whitney Hancock, or, a local bank, or maybe one of the bigger ones like a Bank of America, and find one of these, accounts that are going to pay you to 4 to 5%. So that's what I would look for just to start with, before you get into other, stocks, bonds, things like that.
All right. Thank you, good sir. And the next time the Federal Reserve will meet is coming up in May. We're back after this.